Hey everyone, let's jump right into this. If you're studying for your ACCA financial reporting or SBR exams, consider this explainer your ultimate cheat code. Today, we're completely mastering the asset lifecycle by decoding the core ACCA FR standards. We're going to take a single asset and trace its entire journey, from the foundational rules that govern it, through its physical or even invisible creation, all the way down to its potential downfall. All right, here's our roadmap for today. Number 1, Foundation in IAS 1. Number 2, Tangible Assets, IAS 16. Number 3, Intangible Assets, IAS 38. Number 4, Asset Impairment under IAS 36. And number 5, Final Exam Strategy. Starting off with Section 1, Foundation and IAS 1 Framework Concepts. Think of the conceptual framework as the invisible hand guiding literally all standard setting and accounting choices. Now, the framework isn't actually an accounting standard itself, right? It's more like the fundamental philosophy behind everything. Its whole objective is to provide financial information about a reporting entity that's genuinely useful to investors, lenders, and creditors. And it does this based on qualitative characteristics, primarily ensuring that the information has both relevance and faithful representation. Under IAS 1, those abstract concepts become reality through a complete set of financial statements. This requires 5 specific components: the statement of financial position, the statement of profit or loss and other comprehensive income, the statement of changes in equity, the statement of cash flows, and finally your notes, which include accounting policies. So, the absolutely crucial point here is the baseline assumption for all of this, the going concern assumption. You always assume the entity will continue for the foreseeable future, which means at least 12 months from the reporting date. Take a mental screenshot of this one-line summary. IAS 1 equals full set of statements, current and non-current classification, and the going concern assumption. Seriously, lock that anchor in your mind, because it is the baseline for everything else we're going to discuss. Moving right along to Section 2, Tangible Assets, IAS 16, Real-World Assets. When we initially recognize property, plant, and equipment, we measure it at cost, and that includes the purchase price plus directly attributable costs, like installation. But for subsequent measurement, we get a choice between 2 models. We have the cost model, which is just historical cost minus accumulated depreciation and any impairment losses, or we can use the revaluation model, which records the asset at its fair value minus subsequent depreciation and impairment. Now, listen up, because here's a massive exam trap. If you revalue an asset upwards, so many candidates forget to recalculate the depreciation. You must depreciate that newly revalued amount over its remaining useful life. If you do go with the revaluation model, you need to know exactly where the money goes. An increase in value, that goes straight to other comprehensive income, or OCI, and it sits safely in a revaluation reserve in equity. A decrease, well, that hurts. It goes directly to the P&L as an expense. But watch out for the exception, because examiners literally love testing this. If you are reversing a previous decrease that already hit the P&L, your new gain goes to the P&L first to completely cancel out that old loss. Do not fall for the trap of putting initial revaluation gains in the P&L. Here is your IAS 16 one-line summary. PPE at cost or revaluation. Depreciate over useful life, revaluation gain to OCI. Consolidate your understanding of physical assets right around this single powerful sentence. But let's pause for a second. What if the asset has no physical form? How do the rules change when the asset you've just spent millions of dollars generating is completely invisible? That brings us perfectly to Section 3, Intangible Assets, IAS 38, Invisible Assets. For internally generated intangibles, IAS 38 splits your project into 2 very distinct phases. The research phase is incredibly strict. You must expense all costs to the P&L immediately as they're incurred, no exceptions. But the development phase? Well, you can capitalize those costs as an asset, but only if 6 strict criteria are met. There's another huge exam trap here. Students love to automatically capitalize development costs the exact moment a project moves past research. You can't do that. You must verify all criteria, things like technical feasibility, intention to complete, and probable future economic benefits, before a single dollar gets capitalized. Okay, so once you've successfully capitalized that intangible asset, how do we handle its value over time? If it has a finite, foreseeable life, you simply amortize it over that useful life. But if it has an indefinite life, meaning there's literally no foreseeable limit to the period it will generate cash flows, there's no amortization. Instead, you're required to subject it to an annual impairment test, regardless of whether there are any actual indicators of a decline in value. Time for your IAS 38 one-line summary. Research expense, development, capitalize if criteria met, amortize finite life intangibles. Just memorize this binary rule. I promise it'll bring you immediate clarity in the exam hall. All right, Section 4, Asset Impairment, IAS 36, the worst-case scenario. The absolutely crucial point here is understanding the core trigger. An impairment loss occurs strictly when an asset's carrying amount is greater than its recoverable amount. Think of it like this. If your balance sheet says a machine is worth $1 million, but the absolute maximum economic benefit you can squeeze out of it is only $800,000, well, you've got an impairment. You must write it down. Let's walk through the exact math of IAS 36. Step 1, identify the carrying amount. Step 2, determine the recoverable amount. Now, recoverable amount is defined as the higher of fair value less cost to sell, meaning what you'd get if you sold it today, and value in use, meaning the cash it'll generate if you just keep using it. Step 3, record the impairment loss. And here is some vital SBR examiner intelligence. When calculating value in use, you absolutely must use discounted cash flows. Whatever you do, do not use undiscounted cash flows. A lot of the time, an asset doesn't generate cash entirely on its own, so we have to test a whole group of assets together. We call this a cash-generating unit, or CGU. When you have an impairment loss for a CGU, there is a strict pecking order for allocating that loss. Rule number 1, always destroy goodwill first. Reduce goodwill all the way to 0. Then, step 2, allocate the remaining loss pro rata to the other assets based on their carrying amounts. But remember the floor rule. You can never, ever reduce an individual asset's value below its own fair value less cost to sell, or below 0. Let's cement this standard. Your one-line summary, impairment equals carrying amount greater than recoverable. Recoverable is the higher of VIU and FBLCS. Allocate to goodwill first. Lock that definitive rule in. Finally, Section 5, Final Exam Strategy, Passing the ACCA Exam. Let's look at some insider intelligence, the most common traps students fall into, straight from the examiner reports. Exam mistake 1, sending a revaluation gain to the P&L. The quick fix, revaluation gains go to OCI, unless you're reversing a previous loss. Mistake 2, auto-capitalizing development costs. The quick fix, you've got to check all 6 criteria first in the scenario before doing anything. Mistake 3, using undiscounted cash flows for impairment. The quick fix, value in use must always use discounted cash flows because, the time value of money. Technical accuracy is expected for sure, but applying it to the scenario is what actually gets you the marks. The examiners explicitly state that candidates who just recite standard definitions fail. You have to reference the specific standard number, like IAS 16 or IFRS 15, and apply those rules directly to the company facts given in your prompt. That is how you earn those application and professional judgment marks. So I'll leave you with this final real-world provocation. If your company's recently revalued factory suddenly suffers a massive fire, how exactly will you cycle through IAS 16 and IAS 36 to save your balance sheet? Think about that revaluation reserve you built up. Think about the impairment trigger and how you'll calculate the new recoverable amount. I dare you to go tackle a practice question on this exact scenario right now. Thanks for joining me on this explainer, and keep mastering those standards.